Hopefully all you guys online heard that. So let's.
Yes, we did.
You did? Okay, good. We will get started now. All right. Okay. So, how best to kind of continue on this theme throughout the semester on the Federal Reserve? So, you know, the first week of the semester, we spent a long time talking about the origins, the institutional structure of the Fed, its roles and responsibilities. After that, we moved on to discuss the money supply process, and in particular, how the central bank, like the Federal Reserve, can affect the money supply by manipulating its balance sheet. That was a key concept, key idea. Then we spent a couple of weeks talking about how policy is actually conducted at the operational level, right? How the Fed targets the federal funds rate and how it implements changes in the funds rate. In the past, using a corridor system, today using a floor system. So we went into all of the operational details there. And then we even discussed how central banks can intervene in foreign exchange markets to affect the exchange rate or the international value of a country's currency. Now, when the Fed or any central bank intervenes in these foreign exchange markets or intervenes in the market for government bonds, like an open market operation, it wants to do so by trying to influence the federal funds rate, or if we're talking about any central bank across the world, whatever its relevant policy rate is. When taking those actions, however, central banks obviously have broader macroeconomic goals that it's trying to accomplish, okay? Certainly the Fed in particular believes that its policy actions, its interest rate policy, for instance, can have a big impact on the economy. So what is it that the Fed is ultimately thinking about when it's trying to conduct monetary policy? What are its kind of broader macroeconomic objectives? That's what we really want to start talking about in this, I guess, sixth section of the course. It's divided into two parts, okay? We're going to talk about the first one today and then the second one in class on Wednesday. So the first thing we're going to do is talk about what those primary objectives of monetary policy are in the United States, okay? Now, fortunately, this is really not too controversial, okay? Because as it turns out, the Fed is required by law. That is, they have a statutory obligation to pursue certain macroeconomic objectives. Okay, and we'll talk about what those objectives are. They are embodied in this thing that the Federal Reserve references all the time called its dual mandate. You may have heard of that in these kinds of policy discussions that you see in the news sometimes. We'll talk about what the Fed's actual dual mandate is and how they try to go about accomplishing it in practice. The second part of this section is that we want to take a look at this kind of long-standing debate in monetary economics between setting rules for monetary policy versus something called discretion. All right, now let me just briefly kind of explain what we mean there. When a central bank like the Federal Reserve is deciding on what value to set for its federal funds rate target, there are basically two schools of thought around that policy decision. One is it could set the funds rate according to some fixed rule for monetary policy, where a rule is kind of like a specific formula for how it will adjust its interest rate to changes in the economic landscape. Another philosophy towards monetary policy is to allow the central bank more freedom in responding to the economy as events kind of unfold. That is, to allow policymakers to have much more freedom or discretion. okay? We're going to talk about the differences between those two ways of determining interest rates by the central bank, rules versus discretion, talk about the advantages and disadvantages of each. And that section will culminate in a discussion of a very famous monetary policy rule that is used to inform central bank decisions really all over the world. You may have heard of it before. It's called the Taylor Rule, named after the guy who first popularized it, John Taylor. Okay. Any questions then before we get started on this? All right, so before we discuss these statutory goals that the Federal Reserve is kind of legally obligated to pursue, I want to first spend a little bit of time talking about the Fed's role in affecting what's called macroeconomic stabilization. Okay, the goals of the Fed, I guess, are kind of predicated or based on this belief that Federal Reserve policy actions can actually influence kind of the broader macroeconomy or overall macroeconomic outcomes, right? In other words, the Fed really firmly believes that it can use its various tools like open market operations or interest rate policy or the interest rate on reserves to affect things like output and employment, GDP, even the overall business cycle. It believes that its policy actions have real power or influence over the business cycle. Otherwise, what's the point of this type of macroeconomic policy? There are generally two types of stabilization policies that the Fed will pursue from time to time, okay? The first is what I'm going to call an expansionary policy, all right? Now, what does that mean? An expansionary policy by the Fed is one that tries to lower interest rates, maybe increase the money supply, and cause the economy to try to grow faster, to try to stimulate economic growth or output. That's what's known as an expansionary policy. Some of the lingo that you hear in the financial press would be an easing of monetary policy or a loosening of policy. Federal Reserve officials frequently refer to this as policy accommodation. That's the phrase they like to use. All of those things are synonymous, okay? All of that refers to an expansionary monetary policy, basically where rates are lowered by the Fed to try to stimulate economic activity. The other kind of policy is obviously the opposite, and that is a contractionary policy. A lot of time this is referred to as a tight monetary policy or a restrictive monetary policy. Contractionary policies do the exact opposite. They raise interest rates. That has the effect of decreasing the money supply and causing economic growth or economic activity to decline. I didn't mention this yet, but expansionary policies also have a tendency to raise prices and inflation, whereas the theory is that contractionary policies will do the opposite, that they will put downward pressure not only on output growth, but also prices and inflation, okay? Random events, what we call economic shocks, are always occurring in our economy, okay? And they cause things like output and employment and inflation to fluctuate over time. That is, they generate these things that we recognize as business cycles, okay? The key question here that I want you guys to think about is whether the Fed should use its various policy tools like interest on reserves or open market operations to try to smooth out those business cycles over time, right? When the Fed takes deliberate actions to try to dampen the business cycle, it's engaged in what's called stabilization policy. That's what we mean by macroeconomic stabilization policy, where the Fed is purposefully trying to smooth out those large fluctuations in the business cycle over time, right? That is, reduce output during expansions or increase output during recessions. The Fed can use expansionary or contractionary monetary policies to try to achieve those particular goals. Okay, here's a picture that I think provides a very easy kind of visual description of business cycles and the Fed's attempt to try to implement stabilization policy, okay? What does this figure show? All right, the figure here shows basically a hypothetical path for output or GDP in an economy. So this isn't actual data. This is just a rendition of what the business cycle looks like. So on the vertical axis, we have output or GDP, and on the horizontal axis, we have time. And you can see here that GDP it moves around over time, it fluctuates up and down, but it tends to grow over time. That's this kind of growth component of GDP or output, okay? Now, the red line there that's labeled neutral policy, all right? That shows changes in the business cycle in the absence of any type of stabilization policy by the Fed or by a central bank, okay? When the orange line here is the trend line. That's kind of so trend output. You'll see here that under a neutral policy, these periods where output and employment are above the trend line, this would be an economic expansion, right? The economy is expanding or it's growing rapidly if we're at that point, that part of the business cycle where output and employment are above the trend, okay? Recessions are, of course, the opposite. That's these periods in which output and employment are below the trend line or falling below the trend line, and the economy is in a recession. Now, what would the Fed or what would a central bank ideally like to do over the course of the business cycle? They want to keep actual output as close to the trend line as possible, right? It's not going to be possible to perfectly stabilize the economy against these shocks that cause output to be above or below trend over time. But perhaps the Fed can dampen those fluctuations, all right? That's what this purple line illustrates. This is labeled stabilization policy. That would be the hypothetical path of output, let's say, if the central bank here was effectively able to implement a stabilization policy, right? So as an example, what type of, let's say we were at this point in the business cycle where output is above the trend. What type of policy would the Fed want to implement in order to bring output and employment back down towards its trend? A contractionary or an expansionary policy? Michael? A contractionary one, right? So in expansions, we want to implement a contractionary monetary policy. During recessions, when output is below the trend, you want to do the exact opposite, right? Try to stimulate the economy by implementing an expansionary monetary policy. That will help speed up output growth and get us back closer to the trend line over time. That's what we mean by stabilization policy. Effectively, it means making recessions not as severe, but also dampening these expansions. So economic expansions are not going to be as robust, but recessions will not be as severe. That's what an effective stabilization policy looks like. This type of macroeconomic policy is sometimes described as a counter-cyclical monetary policy, right? Meaning that when output is high, you want to slow down the economy, right? If output is too low, you want to speed up the economy. In some of the sources that you guys read for this class, a lot of academics and central bankers depict this as what's called a lean against the wind policy. That's the same idea as a counter-cyclical policy, right? When the economy is running hot, then you want to contract, implement a contractionary policy to slow the economy down, and vice versa when the economy is running too slow. Okay, questions about that? So this is what a macroeconomic stabilization policy looks like in general, all right? What I want to spend the rest of class today talking about are what the actual stabilization goals of the Federal Reserve are. What are they statutorily obligated to try to pursue in the long run? What are those objectives? Okay, so as I mentioned in the last slide here, the Fed can attempt to use its policy tools to achieve certain goals for the economy's overall performance, okay? We now want to take a closer look at exactly what those goals are, okay? Now, fortunately, there is very little uncertainty about what the broad or basic macroeconomic objectives should be. And that's because the Fed, it turns out, is legally obligated to pursue certain objectives, okay? The logical place to start is an amendment to the Federal Reserve Act that was passed in 1977. Now, that amendment is long, lots of words in it. I'm not going to talk about all of it, but the key part of the amendment that I think helps us understand how the Fed views its stabilization objectives is the following paragraph. The Board of Governors of the Federal Reserve System and the FOMC shall maintain long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production so as to promote, here's the key part, effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. So the emphasis there was all added by me. Now, to keep this in perspective, remember when we talked about the Fed's introduction at the beginning of this semester? The Fed was originally created as this lender of last resort for banks, as well as to try to maintain the health of the payment system. The original creators of this legislation did not predict that the Fed would have such a large role in overall macroeconomic stabilization, that is, trying to smooth out the business cycle. It wasn't really until the trauma of the Great Depression that policymakers started to realize the important role that the Fed could play in trying to dampen those business cycles, all right? And now we know that the Fed is probably the most important policy institution for trying to stabilize the economy in the short run. Okay, the first point I want you guys to look at with regards to the actual legislation is this idea that stable prices and moderate long-term interest rates really go hand in hand. There isn't any inherent conflict or tension between these two particular goals. So even though both of them are stated in the legislation, if a Fed was able to obtain stable prices in the long run, it's probably also going to be able to obtain moderate long-term interest rates. Now, why does this make sense? You guys remember from your intermediate macro class, maybe even your principles class, a famous equation that relates nominal and real interest rates to one another. It's called the Fisher equation or the Fisher relationship. What does it say? That the nominal interest rate is the real rate plus expected inflation, right? Well, the real interest rate is determined largely by factors that are outside the control of the Fed, right? Those are determined by things like the supply and demand for loanable funds in financial markets. Okay? So what does that mean then? If the Fed is able to maintain stable prices in the long run, what do you think that implies then about expected inflation? It's probably going to be low and fairly stable over time. So if inflation is low and stable, what is that going to imply then about nominal interest rates? They're also going to be fairly low or moderate and stable in the long run. So that Fisher equation or Fisher relationship between real and nominal interest rates tells us that moderate long-term interest rates and stable prices more or less go hand in hand. That if you achieve one, you probably achieve the other. There's no real tension between those two goals. Another point I want to bring up about the legislation is these other concepts that it references: maximum employment and long-run potential output or production. Again, just like there's no tension between inflation and interest rates in the long run, there probably should be no real tension between maximum sustainable or maximum employment and this idea of long-run potential output, okay? The Fed basically interprets this idea of maximum employment as maximum sustainable employment. The Fed does not literally think that maximum employment means that everyone always has a job, right? In a big dynamic economy like ours, there's always going to be people that are looking for new jobs. There's a tremendous amount of churn in the labor market. So inevitably, some people are going to be unemployed. The idea is not to drop the unemployment rate all the way to zero, but rather to maintain maximum sustainable employment, which is a level of employment in our economy that is consistent with our economy's kind of long-run potential level of output and production. Okay, so again, this second point is that there's really not a whole lot of tension between this idea of maximum sustainable employment and long-run potential output, that the two are kind of synonymous with one another. What does this imply then? Well, it follows that this 1977 legislation, in my view, and I think in the view of most monetary economists, is that it establishes what's called a dual mandate for the Federal Reserve. So even though there's kind of four concepts that the legislation references, there's really only two long-run objectives. And those statutory objectives are regarded as price stability, which again goes hand in hand with long-term interest rates, and maximum sustainable employment. Or alternatively, you can view this as the economy achieving a level of output that equals its kind of long-run potential level of output. That's what the Fed means by its dual mandate, okay? This concept or idea of a dual mandate was, I think, fully enshrined into law the very next year in this thing called the Humphrey Hawkins Act of 1978, where again, the key language in that legislation was that the Fed would make policy decisions to promote full employment and production and reasonable price stability, okay? So the broad or general macroeconomic goals that the Fed has in mind when it's trying to set monetary policy are clear. It wants to achieve or accomplish its dual mandate, okay? And at every opportunity, the Fed tries to be as clear as possible that it's in pursuit of that dual mandate. It wants to be very transparent, okay? You guys probably know that at this point in the semester that monetary policy is kind of a complicated process. The Fed wants to be as transparent and clear with the public as possible in the pursuit of its goals. And it tries to communicate all this stuff constantly. In fact, let me just take a minute to show you that you can find a statement of the Federal Reserve's objectives directly on their own website. And every time the FOMC meets and makes a policy decision, it references its so-called dual mandate. Every single year, the Fed publishes something called Statement on Longer Run Goals and Monetary Policy Strategy that it makes available to the whole wide world, okay? It recently made some changes to that policy strategy, which hopefully I'll be able to talk about, but it's several paragraphs long, but the main idea is really in the first couple of paragraphs. The FOMC is firmly committed to fulfilling its statutory mandate from Congress to promoting maximum employment, stable prices, and moderate long-term rates. The committee seeks to explain its policy decisions to the public as clearly as possible. Such clarity facilitates well-informed decision-making by households and businesses, reduces economic and financial uncertainty, and increases the effectiveness of monetary policy. It enhances transparency and accountability, etc. Right? So the Fed is, again, communicating to us that it has these clear policy goals and that each of its policy decisions are consistent with these goals. I'll come back to this statement a little bit more later on in the class. All right, so the dual mandate, I think, is pretty clear about what the Fed's kind of general or broader stabilization objectives are. They obviously care about price stability and trying to maintain full or maximum employment, okay? What is less clear, however, is how the Fed actually interprets those objectives in practice. What does price stability mean? Does that mean that the prices of goods and services should be fixed over time? Does that mean that the cost of living should be fixed or stable over time? What exactly does price stability mean? What is long-run sustainable employment? These are kind of general economic concepts, but they're not operational in the sense that they're not specific enough for us to know exactly what data the Fed is looking at when it's making its decision and how we should judge whether or not the Fed is actually accomplishing its dual mandate. Okay, so while the dual mandate is clear about the general objectives, I don't think it's still somewhat vague regarding exactly how the Fed interprets those objectives in practice. All right, so let's start by talking about how we should judge the Fed's performance with respect to the output or employment side of its mandate. Okay, now recall what that mandate says. It says that the Fed should take action to try to keep output as close to this concept of its long-run potential level of output as possible. All right, now potential output may have been something that you guys talked about in your intermediate macroeconomics class. All right, generally policymakers agree that the economy's long-run potential level of output is something that is basically outside of the control of the central bank. The Fed doesn't have a whole lot of power to influence potential GDP in the long run. Potential output is really governed by things like the labor force, trends in the labor force, trends in demographics, changes in technological advancement, or changes in the capital stock over time. All of those things are kind of outside the direct control of monetary policy or a central bank. Now, economists fortunately have developed a concept known as potential output that kind of measures this purely hypothetical level of output over time, okay? Potential output, you can basically think of this as the value of an economy's production, or GDP, if all of our resources were being utilized at a high but sustainable rate in the long run. This is the level of output that doesn't actually occur in the real world. It's just a hypothetical level of output that would be consistent with an economy that is using its resources fully and efficiently over time, okay? If output, think about it, if actual output is bigger than potential output, then what that means is that the economy is running hot, right? That workers are working overtime, capital is being utilized heavily, right? And so economic growth is rising quickly, and maybe even prices are rising as well. If output is below potential, then the opposite is happening, right? In that case, you have resources that are being left idle. Not all of our capital stock is being used. Some of our labor is unemployed or Perhaps workers are not getting as many hours as they normally would. Okay? The Fed actually, in practice, judges whether or not it's accomplishing the output employment side of its mandate by comparing actual GDP numbers to this potential level of GDP. Okay? Now, the series or the data that they look at most closely is a particular economic data called potential gross domestic output. And I don't have this in the slides, but actually it is right here. It's estimated by the Congressional Budget Office, or the CBO. All right. What this graph shows you, again, I pulled this graph from the St. Louis Fed. It shows real GDP and the CBO's estimate of potential real GDP over time. Potential GDP is the red line, and actual GDP is this blue line. And you can see that actual GDP deviates from potential over time. In some periods it's higher, in some periods it's lower, right? Particularly during these recessionary episodes, these vertical gray bars, you see where actual output dips quite a bit below potential GDP, okay? What I'm telling you here is that the Fed determines in practice whether or not it's achieving the output employment side of its mandate by looking to see how closely actual output is to this potential level of output estimated by the CBO, right? So, for example, during the Great Financial Crisis, where GDP tanked relative to potential, the Fed would not have been efficiently achieving its employment output side of its mandate. And that's why the Fed tried to stimulate the economy by lowering interest rates so dramatically during that period, is to help the economy grow back towards potential. How should we judge the Fed's price stability mandate? What does that mean? Well, generally we interpret price stability as not literally that prices are fixed over time, but rather that the economy's inflation rate remains fairly low and stable, okay? But therein lies another problem. What inflation rate is the Fed looking at? I can think of lots of different inflation rates. There's the inflation rate that is constructed using the GDP deflator. There's the consumer price index measure of inflation. There's various measures of asset price inflation. What type of inflation is the Fed actually looking at in practice when it's determining whether it's achieving price stability? Well, again, fortunately, the Fed is pretty clear about what it's looking at. Let me go back to the actual statement of longer-term policy goals. The key paragraph is paragraph 4. The inflation rate over the longer run is primarily determined by monetary policy, and hence the committee has the ability to specify a longer run goal for inflation. I failed to mention that, but that's an important point. Whereas the Fed does not believe that it can really alter potential output in the long run, central bank policies do have a great deal of influence over an economy's rate of inflation. And so the Fed can specify a specific target rate for inflation, and they do. The committee reaffirms its judgment that inflation at a rate of 2%, as measured by the annual change in the price index for personal consumption expenditures, is most consistent over the longer run with the Federal Reserve's statutory mandate. The committee judges that longer-term inflation expectations are well anchored at 2%, foster price stability and moderate long-term interest rates, et cetera, et cetera. There's two important things I want you guys to remember here. With regard to price stability, the Fed makes two things clear. It has a specific inflation target of 2%. Not 1%, not 3%, not 0%, but 2%. I don't know why 2% is a magic number for them, but that's the number that they've selected. The other thing is that they have a specific measure of inflation that they care about. Not CPI inflation, not asset price inflation, but rather it's inflation as measured by the deflator for personal consumption expenditures. This is the measure of inflation that most directly reflects consumer prices, okay? So it's the PCE measure of inflation, and it's a specific numerical target of 2%. Now, with that said, there are many economists and even some policymakers who will admit freely that in practice, the actual measure of inflation that some of these policymakers look at most closely is not the PCE rate of inflation, which is the blue line here from 1960 through 2020, but rather a measure of what's called core inflation. Core inflation is basically just PCE inflation, but you strip out a few items. In particular, you strip out food and energy prices. So the price of gasoline, heating oil, as well as all types of food commodities are removed from personal consumption expenditures. Now, let me stop there and ask you guys why this might make sense. Why might a central banker want to exclude food and energy prices from the measure of inflation that they're looking at when deciding whether or not they're actually achieving price stability? Derek? Okay. Well, not just political pressures, but they can be volatile. Food and energy prices in particular tend to bounce around a lot over time. Okay, there's much more short-run volatility in those prices. You can see here that particularly in the last 20 years, the blue line is much more volatile than the red line. When the Fed is determining whether or not it's maintaining price stability, it really wants to be able to get a sense of what the underlying trends in inflation are. And so, unfortunately, food and energy prices tend to obscure to some extent what those trends are. And so, a lot of times, Federal Reserve officials will want to strip out those prices and look at these underlying core measures of inflation, right? Derek, you can see that in the years leading up to the financial crisis, PCE inflation got close to 4%, right? But core inflation was closer to 2%, right? During the recession and the early years of the recovery, PCE inflation actually went into negative territory, right? So we would think that the Fed is doing terrible on its price stability mandate, but in fact, core inflation did not drop nearly as much, only to around 1.5%. So I show both of those lines there to emphasize this point that yes, they are looking at PCE inflation, but I think actually the one that maybe is even more relevant is this idea of core inflation, which pulls out these volatile food and energy prices. Okay? All right, so are we clear then on what the dual mandate is in theory and how the Fed interprets it in practice? I can assure you on your exam, you will have a question or questions that ask you to explain or identify what the dual mandate actually means. Not just in theory, but in practice. What is it that the Fed is looking at? They have an inflation target. What is that target? It's 2%. What particular measure of inflation are they looking at? Not CPI, not asset price inflation, but consumer price. It's the deflator for personal consumption expenditures. Do you have a question? No? Oh, I thought I saw you raise your hand. Okay, never mind. Yes. It's to maintain, well, what they say, and if you go and read that longer run statement of policy goals, what they want to do is maintain, they want inflation to average 2% over the kind of the medium term. So if inflation has been persistently below 2%, they want to try to bring inflation up to run a little bit above 2% for some time, so that the average rate of inflation in the long run is 2%. That's part of the Federal Reserve language that has changed in just the last few months. They've provided more clarity on what 2% means over time. Okay, so we've discussed then how the Fed uses its stabilization tools to try to dampen business cycles or mitigate business cycles in an effort to try to accomplish its dual mandate. The dual mandate being price stability and maximum or full employment and output. For example, if the economy is growing too quickly, and if inflation is too high, it's above 2%, what does the Fed want to do? It wants to tighten policy with a contractionary monetary policy to try to lower growth and lower inflation. If the economy is running too sluggishly, if growth is too low, and inflation is below the 2% target, the Fed wants to do the opposite. They want to expand monetary policy, loosen or provide more accommodation to stimulate growth and prices, okay? So, a lot of times, the Fed finds that both sides of its dual mandate are compatible with one another. This is an important thing to understand, that in a lot of situations, trying to achieve price stability will result in the same policy that the Fed wants to promote to try to get full employment as well, okay? So in other words, there's no kind of conflict between those two goals. However, there are going to be situations that happen repeatedly over time where trying to pursue both sides of the dual mandate are going to temporarily come into conflict with one another. When that happens, the Fed is going to be faced with an inflation, what I call an inflation output trade-off, right? There's going to be a trade-off between trying to stabilize inflation on the one hand versus output or employment on the other hand, okay? Just as a quick example, what type of policy should the Fed pursue if growth is really low, but inflation is high? Let's say growth is low, we're in a recession, but inflation is above the 2% target. Should the Fed tighten or ease monetary policy in that case? If the Fed wanted to ease policy to raise economic growth, what's going to happen to the inflation rate? It's going to go even higher. So there's a trade-off between the two, stabilizing output and stabilizing inflation. Or alternatively, the Fed can contract monetary policy to try to bring inflation down, but what's going to happen to GDP as a result of that? It's going to fall even lower, and the recession is going to get even deeper, okay? I want to bring up this idea because, you know, a lot of times there's no conflict between both sides of the dual mandate. But in other instances, the Fed is faced with this kind of thorny situation where trying to achieve both sides of the dual mandate is really impossible. That if it stabilizes one, it's going to inherently kind of destabilize the other, okay? Okay, so the question then becomes, how should the Fed chart a middle course between these two objectives during these periods in which it can't simultaneously achieve both sides of the dual mandate? What is the best middle course for the Fed to try to chart? How should it compromise between these two competing goals? Well, we can kind of think about or model how the Fed compromises between these competing goals by developing something that we're going to call an objective function for the Fed. Now, let me be clear about what this is, and then we'll go through some examples of how to construct this. An objective function is just a numerical criterion that assigns specific numbers to inflation and output that enable the Fed to rank different policies. the Fed may have 10 different potential interest rate policies that is considering. What is the optimal one for it to choose? Well, it needs to rank those policies by using an objective function, right? You guys can think of this as kind of analogous to a utility function for individual consumers, right? You guys may not realize it, but you have kind of this internal utility function that you use to rank different combinations of your consumption and your work hours and your leisure hours, right? Well, the central bank's objective function is the same way. It has a bunch of different potential policies that it can implement. What is the best one to follow? It's the one that achieves the highest value of an objective function. Just like you choose your work hours and your consumption to maximize your utility, that's what you learn in your intermediate micro class, the Fed is going to select an interest rate policy to try to maximize its own preferences or objective function. All right, now, the Fed's objective function is going to depend on two gap concepts that are, of course, directly related to or reflect its dual mandate. All right, one of them is called the output gap, and the other is going to be called the inflation gap. All right, let me talk about what these two arguments are, and then we'll put them together to formulate an objective function for the Federal Reserve, so that we have this criterion that we can use to try to select optimal policies. Okay, so again, the Fed ultimately wants to try to keep actual output as close to potential as possible, okay? Potential output, again, is this hypothetical level where the economy is using its resources efficiently at a sustainable rate in the long run. A natural measure then of the output gap would be that we would want to appear in the Fed's objective function then is the difference in percentage terms between actual output and this hypothetical potential level of output, okay? So let me define some notation here. Y, we'll refer to that as real output, YP is potential output, and Y tilde is going to be the output gap. I'm going to stay consistent with this notation over the next several weeks of this course, okay? How do we define the output gap as this argument in the Fed's objective function? It's the percentage difference of potential output from actual. So it's Y minus YP divided by YP times 100%, right? It shows the percentage difference of actual output from potential output. Quick example, in the fourth quarter of 2010, actual GDP was around $13.4 trillion. Potential GDP was estimated at the time to be about $14.1 trillion. So what was the output gap? Well, just plug it into the formula. 13.4 minus 14.1 over 14.1 is about negative 5.2%. So the output gap in the fourth quarter of 2010 was around negative 5%. That it's a negative number tells us what? That actual output is below potential, right? Now, what type of monetary policy could the Fed pursue to try to close that output gap? An expansionary policy or a contractionary policy? Michael? An expansionary policy to try to stimulate growth and lift output up closer to potential output, right? Here is some actual data on output gaps historically in the United States. So you guys can do this, but you can go to the St. Louis Fed website, and they have a tool that you can use to actually create formulas from their data, right? And so I use that tool to compute the output gap according to the formula that was on the previous slide. So it's 100 times GDP minus potential GDP divided by potential GDP. And this is what the output gap series looks like over time, okay? What do you see happening to the output gap during recessions? obviously going down and becoming negative, right? 1971, 74, 81, 83, 91, 2001, and the great financial crisis. All of these are episodes where the output gap reached a trough, right? According to the data here, in the last 60 years, at what point do we experience the largest negative output gap? Looks to me like it's what, 83, but pretty close. So the great financial crisis did not actually result in an output gap that was quite as large as the one we experienced in 1983. But what do you notice about the difference between this recession and this one? This is if you take a close look at the data, it's something changed in the US economy after about 1990. All of these recessions that we had before 1990 were these so-called V-shaped recoveries, where the economy tanked, but then it recovered pretty quickly, right? What do you notice happening, though, after 1990? You have this kind of so-called slow, jobless recovery phenomenon that they talk about, particularly after the financial crisis. So whereas the output gap didn't quite fall as much, it took way longer for it to recover. So in that sense, this recession was indeed more severe because it lasted so much longer. The highest output gap historically was in the late 60s. A lot of monetary economists attribute these high output gaps in the late 60s and early 70s as to one of the main things that drove inflation considerably higher during the 1970s, that we were producing a level of output that was just unsustainable, and the economy experienced rising and rapid inflation the next decade. Okay, so we already know that the Fed interprets its price stability mandate by achieving 2% for PCE inflation, okay? So for the Fed's objective function, it's really straightforward to define the inflation gap. That's just going to be the difference between the actual rate of inflation and the Fed's target rate of inflation. All right, so if we define pi as inflation and pi superscript t as the Fed's inflation target, then the inflation gap, or pi tilde, is just the difference between those two. Again, I'm going to try to stick to this notation throughout the rest of the semester. So lowercase y tilde is the output gap, and pi is going to be the Greek variable that I use to denote inflation. In 1982, PCE inflation, that is core inflation, excluding food and energy, was 6.5%. The Fed's inflation target was 2%. So what's the inflation gap in practice? 6.5% minus 2% gives us a 4% inflation gap. What kind of monetary policy would we want to implement in order to close the inflation gap? An expansionary or a contractionary policy? A contractionary policy, raise interest rates, slow down economic growth, and put downward pressure on prices to bring inflation back down towards target. Okay, you guys have any questions about that so far then? You understand what an output gap is and an inflation gap. We're now going to spend the rest of class today talking about how we construct the Fed's objective function and how it will depend on these two arguments. All right, so we now have all of the key pieces to place in the Fed's objective function, and that objective function is going to enable us to determine what the right policies are for the central bank to choose, because a policymaker will then be able to rank numerically these different policy choices. Now, the specific objective function that it turns out that most central bankers use in their policy discussions, as well as the research papers that inform those discussions, is what's referred to as a loss function. Okay, now I don't want you to get confused about the terminology. But a central bank loss function depends on the output gap and the inflation gap. And it's just a single equation that depends on those two variables. It is a specific type of objective function. Okay? Here's the way I want you guys to think about this. It's a loss function for the central bank that basically shows for a given output gap and for a given amount of inflation, what the cost to society or the economy is for experiencing that level of the output gap and inflation gap. Okay? The greater the output gap and the greater the inflation gap, the greater is the loss that the central bank will experience. That is, the greater is the overall cost of those outcomes to society. Okay? So what we have here is a situation where the Federal Reserve or a central bank would like to select a monetary policy that in some way minimizes the amount of loss that society experiences from these output gaps and inflation gaps. Okay, now, that raises a question. How exactly should the Fed penalize in its loss function these output and inflation gaps? What is the best or most appropriate way to think about how the central bank should penalize inflation and output gap? Well, I think most policymakers and most economists agree that economic loss should increase exponentially with the size of the inflation gaps or the output gaps. Now, let me be clear about what I'm saying there. Imagine that the inflation gap suddenly doubled from, let's say, 1% to 2%. Most macroeconomists would think then that if the inflation gap doubles, the amount of loss or cost to society should more than double as a result of that. That's this idea that losses increase exponentially with the size of the two gaps that determine loss, the output gap and the inflation gap. If the output gap were to decline from negative 2% to negative 4%, then the cost to society should more than double, right? In that case, losses are increasing exponentially, all right? Now, it turns out that a very simple loss function that has a quadratic form to it, so it's an equation to the power of 2, satisfies this assumption about exponential losses. Let's just work through some straightforward examples to illustrate what I'm talking about here, okay? Let's assume that the central bank ranks these different policies according to a quadratic loss function. One that takes the square of the output gap and the square of the inflation gap and sums it up over the length of the policy period. All right, so here's the easiest example I can think of. Let's suppose that the Fed is considering two different policies, policy 1 and policy 2. The first policy is going to expect to produce an output gap of 4% this year and then 0% in the next year. Okay? So it's a contractionary policy, right? It's going to take the output gap from 4% this year to 0% in the next year. Or alternatively, the Fed can implement a policy that is expected to keep the output gap at 2% over the next 2 years. You'll notice here that both policies have the same average output gap. 4 and 0 averages to 2. 2 and 2 average to 2, okay? However, the policies are different. Why? Because loss increases exponentially with the output gap. What is the policy loss under choice 1? It would be 4% squared, this is a quadratic loss function, plus 0% squared. giving a central bank loss of 16. What does policy 2 generate? 2% in the first year squared plus 2% in the second year squared gives us 8. So even though the policies generate the same average output gaps across the 2 years, policy 2 is superior because it results in less loss. And the reason why is that 4% output gaps are more than twice as painful for the economy than a 2% output gap, because loss increases exponentially with the size of the output gap. Perhaps it's clearer if we look at an example with inflation, okay? Let's suppose, again, the Fed has 2 policies that it's contemplating. One yields an inflation rate of 8% this year and then 2% next year. The other policy yields an inflation rate of 5% this year and then 5% in the next year. Let's assume that the Fed's inflation target is 2%. Well, what is the policy loss under the first option? Remember, it's the inflation gap squared over the 2 years, right? So it would be what? 8% minus the 2% target is 6 percentage points squared, plus in year 2, inflation is 2%. So 2 minus the target is 0. So loss under policy 1 is 6 squared plus 0 squared is 36, right? What's loss under policy 2? Well, the inflation gap there is 3 percentage points in both years. That is 5% inflation minus the 2% inflation target. 3 squared plus 3 squared just gives us 18. Again, policy 2 is more desirable. Why? Because losses increase exponentially with the size of the inflation gap, even though both policies have the same average inflation gap, 3% a year. Okay? So this is an assumption that we're building into this objective function, that the central bank, that the Fed in particular, wants to try to avoid these really high output and inflation gaps because those losses are exponentially going to be larger. A simple quadratic loss function encapsulates that idea about exponential loss, okay? Now, there is one more thing that we have to establish here before I call it quits for the day. We've established that output and inflation gaps will be squared in the Fed's loss function, and that they're going to be added up over time. The only remaining question that we need to think about here is how much weight the Fed should place on output gap loss compared to inflation gap loss. Which of those is more important to the Fed? That is, which side of its dual mandate should the Fed put more priority on? The price stability side of the mandate or the full employment output side of the mandate? Well, in truth, economists have different opinions about this, okay? And so what I'm going to do is I'm going to write the loss function in a way that generalizes to different cases here. Ones in which the two sides of the mandate are equally as important, and ones in which either price stability or full employment are the more important objectives. So here's what the loss function is going to look like in general, okay? And I think you guys can understand this. Central bank loss is going to be the sum over time. The last example just had 2 periods, right? Of what? The losses from the output gap. So it's the output gap squared over time, plus the losses associated with inflation gaps, where it's the inflation gap squared over time. Now, what's the last little ingredient that we've put in the loss function here? It's this little Greek parameter here, omega. That omega is the weight or the numerical value that the central bank is going to attach to inflation stability relative to output gap stability, okay? If omega is equal to 1, what does that imply? That implies that the Fed penalizes output gaps the same amount that it penalizes inflation gap. So the Fed in that case would have a balanced approach to both sides of its mandate. What happens, however, if I told you omega was equal to 2? Then what does the Fed care more about stabilizing? Inflation, right? In that case, inflation squared output gaps are going to generate more loss than squared output gaps, right? So the bigger is omega, if it goes above 1, then the central bank is prioritizing inflation stability over output gap stability. If omega slides to lower than 1, however, let's say it's 1/2, then the exact opposite is the case. Now the central bank cares twice as much about stabilizing the output gap as it does inflation. Economists have different opinions about what the Federal Reserve is doing today and has done in the past. In fact, a lot of my own personal research in years past has been trying to estimate models where we get an idea of what this actual weight is in the central bank's loss function, okay? And again, there's different opinions on that, but this loss function kind of encapsulates or encompasses, I should say, all of the different possibilities, okay? So I am basically out of time today. What I want to do at the start of class on Wednesday is to work a practice problem together that applies this loss function in a way where a central bank policymaker can select an optimal policy. So we'll have 2 different policies, and from those policies, we'll generate different values for the output gap and inflation. We can then rank the 2 policies according to a criterion like this loss function to determine what it is a central bank should do. Now, all of this, guys, may seem like this is kind of just a theoretical exercise, but in truth, Federal Reserve officials, when thinking of, in the course of their FOMC meetings, are viewing the economy in this way. They have some idea about central bank objectives as measured by some type of loss function like this, and they have a whole bunch of models of the economy, forecasting models of the economy, that they can use to see how different monetary policy settings generate different possible paths for the output gap and inflation. They can then plug those values directly into this objective criterion to try to figure out what the best path of the policy interest rate should be. So this way of thinking is very much how actual central bank officials kind of view the world when deciding on the best course of action for monetary policy. We'll do a simple kind of straightforward example of that, and then we'll finish the class talking about this idea of rules versus discretion, okay? That's all I have for you guys today. Thank you.